Hey everybody, welcome back to another edition of 5 Question Friday. Yes, I know I'm not in my typical button-up shirt. It's a t-shirt day and that's just how I felt, so here we go. I've still got 5 great questions for you. These are questions that you all have sent in. If you want to submit a question, the best way to do it, subscribe to the newsletter with the link below the video. It's free, goes out every Sunday, and you can just hit reply and send me your questions. And so let's get started. So our 5 questions for today, you see them on the screen. First is you've got a 401k at work, but your employer doesn't match. Should you just stop contributing and start contributing to a Roth? We'll look at that, the Roth IRA. Where should you keep cash you might need in the next 10 to 12 months? Can you implement the bucket strategy in Boldin? 4, I like this one, SCHD, that's a dividend value fund. We'll talk about it, plus tips and chill. In other words, in retirement, could you just hold these 2 funds, a SCHD and then maybe a TIPS fund, and that's your total portfolio? Does that make sense? Any issues there? And then 5, do short-term Treasury bills provide the same inflation protection as TIPS? That's an interesting question. All right, so let's dive in. This first one came from Tracy, and I think there are a couple of considerations here and some things to keep in mind. First of all, her question was between a 401k, I'm going to assume a traditional 401k, and a Roth IRA. Now, her employer may also offer a Roth 401k. So let's just assume for the moment that the employer does. If they don't, you've got traditional 401k versus Roth IRA. The first question is going to be, just from your own tax situation now and your best guess as to what it'll look like in the future, what makes more sense, contributing to a traditional retirement account or a Roth retirement account? There's a couple of different ways to think about that. As a general rule, you could say folks in the highest tax brackets, particularly if you're in a high income tax state as well, often want to go the traditional 401k or traditional IRA route to get the deduction. If you're in lower tax brackets, the Roth may make sense. Just keep in mind that in thinking through what's best for you, it's not just what taxes you'd pay now if you went with a Roth and had to pay taxes before your money went into the account, versus the taxes you might pay, 10, 20, 50 years from now when you retire, perhaps when required minimum distributions kick in, but also what your tax rates might be, particularly as you get into your 50s and 60s. Maybe you retire early, and by early I really mean before Social Security and Medicare kick in, because you could do Roth conversions during that time period. So there's a lot to think about, but as it generally, that's sort of the analysis you try to go through and just do the best you can. But as between a 401k and an IRA, the first thing is, I like the convenience of a 401k. It comes right out of your paycheck. It's automatically deducted and shown in your W-2 that you get at the end of the year. Of course, I want to think about the investment options that are in the 401k. Hopefully you have some low-cost index fund options. If you don't, then that's going to be a vote in favor of an IRA. The other thing to think about is, if you're really going to go with a Roth IRA, if you choose to move away from the 401k, it is nice, if you don't have one at the moment, to get it opened, make a contribution, so you start that 5-year requirement to hold a Roth IRA before you can take out qualified distributions. And so it's nice to get that clock running. So that's at least something to think about. Beyond that, for me, it's a question of convenience and a question of investing options. So that's my answer. Sort of a lot to think about. Often there's no one right answer to the question, but those are at least the things that I think about in making that sort of decision. Great question. All right, number 2. Where should we keep cash we'll need to spend in about 12 to 18 months? James had this question. Sold a home, has some cash, and they mentioned SGov. I think SGov is a great option. I don't own shares of it now, but I have in the past. Here it is. Here we go. It's an ETF that holds basically treasury bonds. iShares 0 to 3 month treasury bond. If we go to the quote page, we can see that, and they've changed this a bit. We got to go over here. There we go. There's the yield, 4.17. The net expense ratio is just 9 basis points. The one that I like and actually hold right now is V-Bill. This is from Vanguard. It's basically the same thing. It's 2 basis points cheaper. Probably not going to make a huge difference, but I figure, I can buy these ETFs from just any broker. So why not go with the one that's a little less expensive, even if it's only 2 basis points? And you do actually see it show up in the yield. So V-Bill is what I'm currently using. But again, I think SGov is a perfectly reasonable choice. And I think those are both great options. I think they're great options for an emergency fund. They're great options for money you're going to spend in the next 6 to 12 months, if you will, which is what we're using them for. And so those are I think are both good options. All right. Number 3. This is from Neil. Can you implement the bucket strategy in Boldin? I actually talked about this in this video. This is going back September of 2024, so not that long ago, but the video is really about some of the hidden challenges of the bucket strategy. And then towards the latter parts of the video, I pull up Boldin on the screen and I walk through it. But let me kind of give you just the high level issues. And I'll show you Boldin in a second, but here's the thing to keep in mind. If you have a portfolio, and it could be a collection of accounts, some Roth, some traditional brokerage, but in each of those accounts or your portfolio as a whole, you have, I'll call it a traditional asset allocation. You're not using the bucket strategy. You have a 70-30 portfolio or a 60-40. You can look at sort of the historical data and come up with a reasonable expected rate of return over the long term to use in retirement planning software like Boldin. And the key, though, is that you'll be rebalancing according to some schedule that you've set. It could be once a year. It could be when your portfolio moves away from your plan by a certain amount, but you're going to be rebalancing back to whatever your asset allocation is, 70-30, for example. And so the rate assumptions you use in Boldin, you're going to always be at that same asset allocation. And so your assumptions generally should hold. Again, in any given year, the actual returns could deviate significantly, but from a planning perspective, I think it works. What does the bucket strategy do to that? Well, what the bucket strategy does is effectively put you in a position where your asset allocation can change from year to year. It doesn't always go back to, say, 70-30. If the market's down, of course, your stocks have fallen. Normally, you'd rebalance back to 70-30, but with the bucket strategy, you're not going to do that. You're going to leave stocks alone. Effectively, you're not going to buy more stocks, right? That's what you would do if you had sort of a traditional, again, I'll just use 70-30 as an example. Stocks were way down and you rebalance back to 70-30. That would effectively force you to sell some fixed income and buy stocks or stock fund. With a bucket strategy, you often don't do that. You don't sell stocks. That's good. But you don't buy them either. You leave them alone and you continue to spend down your cash and maybe your second bucket of fixed income, bonds and that sort of thing. And that could mean, particularly if stocks are down for a couple of years, that your asset allocation is changing each year. That's very difficult to model in any retirement planning software for a couple of reasons. First of all, you don't know when that's going to happen. Is it going to happen this year and the next year, or maybe the markets will be up and it'll happen 2 years from now and years 3 and 4? There's just no way to know that. And by the way, once we get through that, it's going to happen again in year 12 and 13 in retirement. There's just no way to know. And there's also no way to know how bad the market's going to be, which would then tell you just how much your asset allocation would change. Now, if there aren't extreme changes in the market, maybe your asset allocation doesn't change that much. Maybe instead of 70-30, you're, it's 65-35, and you might leave your rate assumptions alone in a retirement planner like Boldin. Because remember, it's not an exact science. We're just trying to get close enough with our planning and our estimates. I suppose what you could do is just change your rate assumptions as your asset allocation changes. That's possible, but you're going to be changing them back, presumably, when the market recovers. I guess that's not the end of the world, but it's just not really doable to model that, I don't think, in any easy way in Boldin. Although I think, if my memory serves, I tried to show you different ways to do it. One of the things I mentioned in Boldin is you can create these accounts if you're doing it manually. They don't have to map one-to-one with each of your accounts. For example, in this demo, I've got a 401k here, just one account. But let's imagine you've got a 401k. I might divide this into 3 or 4 different accounts within Boldin if I wanted to. For example, I could even label this. I could come in here and say, you know what, I'm going to make this my bucket number 1 account, right? And it's going to have cash, for example. And I could save that. And I could say, you know, I'm going to make this my bucket number 2 account, and it's going to have fixed income, right? And then in Boldin, you can transfer money between these accounts through money flows. I could create a transfer right here. I've got one already, but I could add a transfer. And I could say, well, I want it to go from bucket 2 to bucket 1, and here's the amount. And but then you say, okay, when do I want this to happen? Well, I'm not sure. Once a year, I guess, if it's going from bucket 2 to bucket 1, maybe. But what if it stocks, bucket 3? Is that going to happen this year or not? I don't know. What about the following year? You see the problems you get into. And this is not a shortcoming of Boldin. It's just the reality of the bucket strategy. It doesn't lend itself well to retirement planning software. But again, you can make it work. You just have to recognize that you're going to put a rate assumption, which is really what matters, for each of your accounts. And you just may have to update it from time to time as your asset allocation changes. So there you go. That's my best take. By the way, if you know of a great way to model the bucket strategy that maybe I haven't thought of, let me know or leave a comment below the video, and I'd be happy to share it in a future video. I'm just not smart enough to come up with what I think is a clean, simple way to do it. I've tried, I've failed. There you go. But great question. All right. Question number 4, SCHD and tips and chill. I've been doing tons of research on SCHD, and I'll show you that fund in a minute. I'm intrigued by the principles of this fund in retirement. What would be the problem with running 60% SCHD and 40% tips? Well, let's look at SCHD. Let's see, it's right here. And I own shares of this fund in my Roth accounts. It's a large U.S. Company stock fund. You can see it's a value fund. The blue dot's all the way to the left of this value column. What that simply means is it invests in typically older companies that don't cost as much when you measure it based on their price to earnings. And so you can see their price to earnings here is about 13 and a half. If we were to look, we can actually look at just an S&P 500 fund. It's should be over 20 now, right? Let's take a quick look. This is Vanguard's. Is it 22 or what is it? 21. So when we say value, that's what we mean. When we're looking at it from price to earnings, it's less expensive. We could look at it from price to book or price to sales. You'd see the same thing. In fact, let's do that. Price to book of the S&P 500 is 4. If we go back to SCHD, the price to book is going to be lower than that. Yeah, 2.81. And so that's what we mean. And if we look at the actual companies it owns, you're going to be familiar with them. Verizon, Coca-Cola, it used to be Philip Morris, ConocoPhillips. Notice what you're not seeing there. Microsoft, Apple, Tesla, right? Alphabet, all of the sort of growth companies, right? So the question becomes, could we invest our entire retirement portfolio, the equity part of it, in just this fund? How would that work? I can tell you I have a couple concerns with that approach. I own shares of the fund, so I think it's a good fund. I'm happy to own it. And I own it in part because of its low valuations. I don't actually own it because of its dividends. But value funds generally pay higher dividends. That's just the nature of the companies that get classified as value. But I would have some questions for someone with this approach. One would be, what about international stocks? I'm a big believer, and I have been for a long time, that we should have exposure to international stocks. And investing all your equities into this fund would not give you that. That would be a question that I would ask, and why I wouldn't go with that approach myself. I want some international exposure. That's the first question. The second question is that what history tells us is that sometimes value stocks outperform and sometimes growth stocks outperform. And more recently, by that I mean the last 10 to 15 years, growth stocks have pretty significantly outperformed value. Now, that could be changing now. We'll see. It will change eventually, and value will have its day for some period of time. But are you going to be able to stick with this plan when value underperforms growth for, say, a decade? And what is your reason for taking that risk? So for me, I just prefer to have my overall portfolio in the blend category, combination. So that would be S&P 500, total stock market. As I said, I put our Roth in this fund because I like the valuations. And I might even move a little more money into SCHD. But if you looked at our portfolio as a whole, our equities, it'd be right in the middle here. I'm not weighting it towards growth or value in any significant way, because that's just a bet I don't feel that I need to take. And so those would be questions and concerns I would have if you were going to put all of your retirement in this one fund. The other thing I'll mention is that I would not be thrilled about putting all of our money in TIPS either. TIPS are great. I own TIPS, Treasury Inflation Protected Securities. But remember, TIPS come with an insurance policy. I've said this many times, but for those that are new to the show, you get an inflation protection. It really is like an insurance policy, and TIPS will increase the principal amount of the bond by inflation, and they'll apply the interest rate to that higher balance, the coupon rate, as they calculate interest payments you're going to get from the bond or bond fund. And then when it matures, you'll get that higher amount, assuming we've had inflation, during the course of owning the bond, and that's great. But you pay for that insurance policy. It's not free. And you pay for it with a lower yield. If you get just a regular U.S. Treasury bond, same term, let's say a 10-year, you're going to get a higher yield on that than you will with TIPS. Again, with TIPS, though, you get that inflation protection. And so the question becomes, is the insurance policy worth it? Did you get a good deal? And the short answer is we don't know. There's no way to know the future. You won't know until you get there. If you would have preferred to have TIPS, yeah, you had a lower yield, but the inflation was higher than the market expected, and so you actually did better because of that inflation protection. Or maybe inflation was lower than the market expected, and you would have been better off in just nominal, regular Treasury bonds. And so I don't like to put all of my eggs in one basket, so I like a little bit of both. That's my approach. That would be my concern with putting 100% of my portfolio, or my fixed income portfolio, in TIPS. All right. Number 5. This question, I love this question. All the questions are good that you guys send me. This one really I found fascinating. Here's the question. Does a short-term treasury fund, we just looked at this, such as the new V-bill, right? We looked at that. It's just so we remember it. It's right here. And it's a ETF of treasury bills from Vanguard. I own shares of it. Provide the same inflation protection as TIPS. I'm not seeing a reason that anybody would choose TIPS between these two, since the yield is lower and they will both follow changes in interest rates. Great question. The short answer is that no, treasury bills don't provide the same protection against inflation as TIPS do. And let's try to understand why. So first of all, this is a short-term, very short-term bond fund, right? In fact, we go to the portfolio, the duration is probably less than a month. Yeah, look at the effective duration. I guess that's not less than a month. It's maybe a month. That's 0.11 years, so we'll call it a month. So it's a very short-term a bond fund, and so it poses very little interest rate risk. If interest rates were to spike, the value of this fund wouldn't go down much because the bonds in it mature in a very short period of time. In that sense, you could kind of think of this like a savings account. It's not a savings account, but for our purposes, you could think of it like a savings account. But here's the thing. Treasury bills and short-term savings their yields don't always exceed inflation. Sometimes inflation's higher than the yields on short-term Treasury bills. So that's the first thing to keep in mind. But the second thing is that yes, you're gonna if inflation spikes and the Fed raises interest rates, interest rates on T-bills go up, you're going to see that very, very quickly in this type of ETF, right? So you will see it react very quickly to current yields, whether they're going up or they're going down. TIPS behave differently, though. And TIPS, of course, you can have longer durations, right? You could buy up to a 30-year TIPS bond, and you're going to get a certain yield, and it's going to be effectively as guaranteed as we can get in this life, that you'll get that yield plus inflation. And so in that sense, tips function very, very differently. And I see them as very different purposes. I see this kind of fund as excellent for emergency funds, right? For cash you're going to spend in the somewhat near term. We looked at it just a minute ago, and someone looking to spend money in 12 to 18 months, I think this would be a perfectly reasonable place to park the money. And that's what I see as the function of a fund like this. Tips I see for more longer term investing. Now there are short term tips, and one could make the argument that a short term tips fund, now it wouldn't be that short, think maybe 2 years, might even be a more pure way to get inflation protection over longer term tips that are more subject to changes in interest rates. But for me, I try to keep things simple. An intermediate term tips fund, intermediate term nominal bond fund like BND from Vanguard, just as an example, is a great way for sort of longer term investing. Generally, the yields on those kinds of investments are going to be higher. And remember, you can't just look at the yield of tips. I understand an intermediate term tips fund will have a yield that's lower than the Treasury bill or T-bill ETF. But remember, you're going to get the inflation protection on top of that, and you won't with an investment like V-bill. So they're really two different types of investments that, at least in my mind, serve very different purposes. And so particularly someone that's like looking for a longer term inflation protection, and so you might consider a tips ladder, for example, which I think is a good way to go in a lot of different scenarios, like bridging a gap between when you retire and when you start taking Social Security, or perhaps a longer term tips ladder to get some security for certain spending that you might have in retirement, that you know that money is going to come in and you know it's going to be protected from inflation. You can get that from a tips or tips ladder. You really can't get that from Treasury bills or a Treasury bill ETF like Vanguard's V-bill, at least in my view. But great question, very thought-provoking, appreciated as always. If you have any questions, you have your own thoughts about what I've talked about today, please leave them in the comments below, and I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.